we've had one of our kind of, I guess, playing FTSE favourites to think about. Maybe not a favourite to own, but a favourite that we like to keep our eye on and report on and see how things are going. Teladoc has reported this week, right, Steve?
It has, yeah. This is one that I used to hold in both sides of my portfolio, but I recently took it. I feel like it was fairly recently. Took it out of my main portfolio and just left it in the money incinerator pie because that name just seems to suit it a lot better. And I have been sort of perpetually disappointed with Teladoc as it's gone on. I think it was very promising, and then it got still quite promising, and then it got fairly middling, and then we haven't covered it for the last couple of earnings reports because it's just been on a continual decline and definitely not meeting the promises that it's set. But look, I'll give you a quick rundown of what Teladoc's earnings were, and then you can have a think about what you think about it. So revenue grew 15% year on year to $637.7 million. Net loss was $23.49 a share, which is just a bit less than what the stock trades for. So again, almost all of this was a markdown in that disastrous Livongo merger, and there was about 31 pence worth of stock-based compensation as well. So there's ironically going to be some sneak profitability here when you sub those both off, which is shown in the EBITDA figures, which were about 94.1 million. So that's up 22% year on year. Guidance is what I think has sunk the stock. It fell about 9% on the news. Teladoc gave guidance of 2.55 billion to 2.675 billion, which is between 7 and 11% growth. Analysts were hoping for 2.7 billion at the low point, so it's quite a bit under. The next quarter guide, which was for 610 to 625 million in revenue, which is pretty meagre growth again. That's about 9%. Only a couple of years ago, they were telling us this would be a 25 to 30% growth engine for a long period of time. So that's definitely starting to hold up. Net losses were projected to be $1.75 to $1.25 per share for the full year. EBITDA of 275 to 325 million in the positive, which is good. So yeah, early on this was a great growth story. I thought this was a company on the cusp of sort of free cash flow positive earnings, growing at 30%, had a very positive outlook, and unfortunately they've been just drawing this back and back and back now, and we're now at the point where we're only expecting 10% growth. And I feel a little bit for Cathy Wood because she's had a terrible year. She owns 12% of this company now, Steve, and that's actually more than BlackRock and Vanguard combined. I mean, chronic care still looks really flat. That Livongo merger has been a disaster. 18 billion has just not brought anywhere, that kind of value to Teladoc. BetterHelp, on the other hand, still looks like it was an excellent piece of business, but unfortunately the two don't cancel each other out. So I guess the bull side of this argument is going to be, well, what did you expect? Tech industry sacking people left, right and centre. How could Teladoc grow any more than sort of 8 or 10%? And I actually think this still needs more time, and I think contrary to the sort of ridiculous takes that I've seen on Twitter that every time it writes down, somebody thinks it's going to go bust, Teladoc actually has $1 billion in cash, and it's now generating cash in most quarters. It's trading at about 18 times its guided EBITDA, but the Teladoc experts are experts in revising this figure down, so it's not an impressive report, it's not an impressive guide, but what did we expect, Steve?
That's kind of the question, I suppose. I feel like every time this company writes down some more goodwill, and I think it's now written down more or less the entirety of the Livongo acquisition.
Pretty much,
I can see of it. So it makes it look like it was basically just a waste of that much money. And I find that quite hard to believe, by the way. I find it sort of difficult to think they got nothing from that. I don't find it at all difficult to think they overpaid. I find it hard to think they didn't overpay substantially, in fact. But I don't see that they got kind of nothing from this. And I sort of wonder at what point this starts looking in some way interesting, because to Cathy Wood's thought here then for a moment, she owns a lot of this company, and she will have bought a lot of this company a lot higher than it is now. I wouldn't be surprised to learn that I would, but I'll come back to this thought in a second. I was going to say, I wouldn't be surprised to learn that she'd bought some of this when it was around 292 a few years ago, when it's down sort of around 90-ish% from there. That's a lot higher, and that was that was almost certainly a bad price to be paying for a company in that state, whichever way you want to look at that. The reason I say I might be surprised to learn that is that she'd already sold it and bought it back again by that point, the rate that they turn things around at ARC. That's the way they go about doing things. Sort of over the long term, could this work out as a decent bet from here? I mean, you said 2.6 billion in revenues guiding for. The stock only trades at about 4 and a bit, and this can't have huge costs in it once it gets to the kind of optimized state, I think. I feel like there's got to be something kind of positive to be done there, and I'm sort of thinking, okay, it's not happening soon and it might not be happening soon enough for investors, but is there a price where this becomes interesting?
Well, it's the problem is it's not going to be at a price that's interesting to us. It's a price that's getting interesting to other people, and you've got to think only about 6 months ago Amazon started its purchase of One Medical, and they paid $3.9 billion for One Medical, which is nowhere near the level of scale that Teladoc has, and nowhere near, the level of profitability that something like that Teladoc is in. You just got to wonder now if Amazon are sat there thinking, God, if we'd have waited 6 months, just 6 months, we'd have been able to pick up, essentially to be the market leader. You can buy the market leader in this segment for just over $4.5 billion. It's another 700 million over what they spent on One Medical. That is nothing. And the problem with that is that if it's nothing to Amazon, who probably now will not be allowed to make the deal, it's still nothing to other companies who will be allowed to make the deal. So Teladoc, to me, looks like, especially now that it's got itself into such a position where, it's generating free cash, it's not burning cash anymore. I think the chances of it going bust are very, very slim. You would say that you would now class this as a cyclical, because when the markets have turned against Teladoc, then its growth has completely slowed, and as it gets bigger and bigger, that would probably start to reverse. You'd assume that when people start to get fired or laid off, their medical care with Teladoc will end as well. So I don't think it's at the kind of size where that's going to, reverse at the moment. I think there's still going to be growth, and when the market does recover and the economy recovers, then Teladoc should start growing at a decent clip again if it can somehow get itself into that kind of position. But I worry about people buying now actually ended up with a decent return. I think that's my big issue with Teladoc. I think the problem is that this could just be taken out for $4.5 and $5 billion, and I don't think the Teladoc shareholders will probably have the gut to turn down a deal like that.
That's interesting. I was sort of thinking about that in the context of if I'd bought Teladoc shares a long time ago. It's one thing to think, I'm an investor, I'm thinking for the long term here. I don't really care where the share price is this year or in fact next year. I don't plan to do anything with the stock this year or next year apart from maybe buy more of it. And if someone makes me an outrageously high offer, well, maybe I'll sell it to them. But the risk of acquisition here, I think, is probably the most serious one to think about, because if you bought the thing anywhere near even 200, you'd be worrying that you're going to get taken out higher than the current price and lower than the price you paid for it, which would be, I guess, a bad result. And I suppose that's the natural risk of these things. But as you pointed out, these kind of goodwill write-downs are getting in the way a little bit if you just kind of scan over the headlines. This is a profitable now company in free cash terms. The goodwill charges are not cash charges, so cash-wise, we're coming in okay and positive, and we're not burning the stuff anymore. So debt's we probably don't need debt for the moment, and let's think it will be. Teladoc will think once, twice, 3 times, and probably again before it does any more attempts to try and merge or acquire or anything, because I think its shareholders would have a fit, and hard to blame them, to be honest. So in that situation, then you've got $1 billion in cash. You're generating stuff from a buyback, and you're edging towards you're generating stuff from free cash flow, and you're edging towards efficiency and operating optimization and so on. Do you think the right thing to do here is for Teladoc to buy themselves before somebody else does via a buyback?
Potentially, yes, to try and get that share price moving. But I think the issue Teladoc has got is that I think investor sentiment is completely crushed around this company now. And I think it's twofold. I think it's because it's been a very poor performing stock, but also because Cathy Wood owns it, and it's fun to hate on Cathy Wood, isn't it? And I think this happens not just at a retail level. I think this happens at an institutional level as well. So I think Teladoc is in a spot of trouble in that regard. But I noticed that they're spending a lot more on sales and administration. So I think they seem like they're really against spending it on this buyback, I think what they're really trying to do is just keep that growth going. I think what they don't want to be doing is pivoting into focusing on being a profitable only business and sort of sacrificing what growth they can get. I think they just want to sort of meander along, growing at a sort of slow pace. I mean, 10% is not the end of the world, but it's not Teladoc growth. But once they get to, hoping for a better market when maybe these tech hires, start being taken on again, that perhaps that they can, reignite that growth back into the 20% mark. If they do that, this will look like a very exciting proposition going forward. If they don't manage that, then it's kind of worrying how they go from here. But at this kind of price, again, you nailed it when you said it's a real acquisition worry. I mean, that must be giving Kathy sleepless nights. She must be down 50, 60, 70% on this stock, and somebody could take it out and offer her nowhere near the premium required. And that would just be burning money.
Yeah, that would be the real, I guess, probably worst case scenario, I suppose, is it's unlikely to kind of disappear out of existence without being acquired, though, I guess. And I find it hard to see how much lower this share price can go. I mean, anything can go anywhere, right? Either because of some sort of exogenous event, something could push the stock market down in general if inflation keeps coming in high, especially if they keep looking to build out their sales and marketing division. But based on its kind of value here, we're at twice sales now, or so.
Something like that, yeah. Not even quite that, is it? It's under that, and yeah, they're talking about sort of between 15 and 18 times EBITDA, depending on which one of those figures you like best. It's not an expensive. I even saw Waste on Capital on Twitter, who is very, very negative of tech stocks. He usually picks out and just highlights all the crap that he hates, and he's really aggressive with how he sort of feels about companies. And even he sort of looked at this and went, this isn't a massively terrible report, if you know what I mean, and this isn't a massively terrible valuation. This stock has fallen a long way, and not that it can't fall in half again from here. Investor sentiment really is that low on it. I don't think a lot of people would want to admit publicly that they own Teladoc stock. And the minute the report came out, I had people in my DMs saying Teladoc's a bag of crap. But I don't know yet. I'm not ready to fully declare that yet, Steve. I'm not a million miles away from it. Don't get me wrong, but I'm not ready to do that just yet.
The cheaper this gets, the more I like it, which sounds dumb, but is quite significant here because more trivially than anything, the cheaper it gets, the more I like it here. I mean, 9% growth then in revenue it's not explosive, but it doesn't need to be explosive if you're only going to pay 1 3/4 times the revenues to buy the thing. And if you think profitability is coming and will come, and there's cash on the balance sheet to reduce the risk, I don't think this is the worst thing in the world to be holding at the moment. I'd be much happier holding it here than I would have been when it was trading much higher, which is, I suppose, the wrong way round to how most people sort of think about these things. But there we are. That's my kind of view on them.